Welcome to QuickBooks at Kapiolani Community College. In this video, we'll take an in-depth look at end-of-period procedures and budgets for a merchandising business. A couple things to remember about the chart of accounts at QuickBooks. If you try to delete an account, all you can really do is make it inactive, unless you have met the criteria that's listed back in Chapter 5 about how to actually be able to delete an account. So if you're having any problems with that, check back with Chapter 5 or check in with me. When you make the closing entries for net income, you should end up with a debit balance in your retained earnings account during whatever period you are doing the closing entry for. So thus you'll still have credits for revenue accounts and debits for expense accounts, and when you debit the retained earnings account and credit capital, you will end up with a debit balance in retained earnings because there's nothing in there until you actually end the period and roll over to the following period. At any rate, the capital account should end up with the balance including net income for the period and minus drawings. That's really considered a controlling type of account. It has sub-accounts. It's not supposed to get any kind of entries directly to it, but the book author goes ahead and lets it happen. More rigid accounting systems wouldn't let that happen. So the textbook author is also very lax about making changes to prior periods, like it's not a big deal or it's no problem. It's really a big deal and a big problem for accountants. Every one of the entries that you have to beginning balance equity or to the services or miscellaneous accounts back in the prior periods, those uncategorized accounts used to set up the company, any one of those that's entered after the start date of the current fiscal period is really a nightmare for any of the accountant reviewing the company's books, because you have unexplained differences in current period that mess it up. So when you enter a correction to a closed period, you're going to have to you will be changing the balances of at least two accounts on the beginning trial balance of this period, which is always a problem. You're supposed to be carrying over whatever it was at the end of last period, and that'll be the beginning of this period. So if one of those accounts is income statement account, like revenue or expense, then your retained earnings is going to be off. And if this period's retained earnings is off, then you're supposed to actually be doing something called a prior period adjustment, which is a sort of a formal procedure to say we messed up in the past and now we're fixing it. And so that's more complex than just sneaking in the adjustment to the beginning period. Additionally, if you're trying to get your financial statements for the current period cranked out, they're not going to balance because the carryover, like especially statement of cash flows, because the carryover balances will no longer work because they're not the same. So a prior period adjustment, should you decide to do it, would show up on a statement of owners or partners equity for a proprietorship or partnership, or on the statement of retained earnings for a corporation or LLC. So you have to keep correct books and records. That's your responsibility. If you made corrections to prior closed periods, then you should keep a record of all those changes that you made. And that's so because the beginning trial balance is no longer going to agree. There'll be at least two accounts that are different, and any of your tax returns filed for the previous period are going to be wrong too, because you will have changed numbers that appeared on them. So a couple other things in this chapter that are issues. When you make a reconciliation and you have a problem getting it to come out, and QuickBooks says, would you like me to help you? Don't say help me. But if you went ahead and did it, it's not an acceptable permanent solution for them to do reconciliation adjustments. That is just compounds your work. So you always want to clear the balance of the reconciliation discrepancies account. It's not really a real account, and you would not allow that to appear on your financial statements. It's kind of an embarrassing thing, actually. So to undo a reconciliation, you can only undo it manually currently in QuickBooks by removing the one R at a time for each of the reconciled items. But an accountant user can undo the reconciliation. So for example, if you invite me as your accountant user, I can do it. And if you don't even have me, then you can invite yourself as an accountant user. Not sure if you need a separate email account or not for that. So adjusting entries that happen at the end of the accounting period, there are several sticky items here in this chapter. One of them is notes payable. Typically, fully amortized loans have a fixed payment amount, so you have like one straight payment amount, and the part that's principal and the part that interest changes over time. And the interest gets charged on the outstanding loan balance, and then the remaining part of that fixed loan payment covers principal. So the principal interest mix changes over time. If you were to click on this link here and pull up an amortization schedule, then you can go ahead and crank in numbers over here on the left, and it will generate information for you. However, it's a lot easier if you just wait until the end of the accounting period and do an adjustment then, especially if you have multiple loans and you're talking about multiple months. But at any rate, the author says get in there, edit transaction by transaction, and do a split to break it up between the principal and the interest part of each payment. So as I said, you can do it at the end of the period by one-shot entry in the journal. And what you do is something like this. One is, let's say all of your loan payments got debited to the office equipment loan liability account and credited checking. Then when the loan account shows up on your balance sheet, it'll look like it's been paid down by the gross payment amounts, but it's only been paid down by the principal payment amounts. And the loan interest account won't have anything in it because you won't have reflected anything in that. So what do? You debit loan interest expense for however much the interest was that you paid for the period, and credit notes payable to bring it back up to the correct balance. Now the other option is that all of your loan payments got debited to the loan interest account because maybe most of it was interest. So you figured, man, just send it there. So in that case, you basically do the opposite of the entry that you have here. And why is that? Because your loan interest expense account is too big, and loan account it looks as though it hasn't been paid at all. So do this adjustment to debit notes payable and credit interest expense to bring them back into alignment for whatever the principal amount was that was paid for this period. Now on your bank statement, you'll see bank charges and interest earnings, and you can go ahead and enter them before doing the reconciliation, or you can enter them in the boxes that are provided in the reconciliation panel itself. I think it's better to just have them done ahead of time. Also, inventory adjustments. There are two possible ways to do adjustments. One is quantities and the other is adjust the starting date. If you have a previous period that's been closed, adjust starting date just kind of messes things up. So typically you don't really want to do that. So it's best to just keep a good record of the adjustments to your opening balance equity whenever that occurs. And you want to adjust, when you adjust quantities, that's going to affect the income of your current period, not beginning balances. So I think it's intended really for a downward adjustment, and it ends up impacting your net income and your inventory. So you'll debit inventory shrinkage for adjust quantities and credit the inventory asset to bring it down to whatever it ought to be. And if you look at adjust starting value, that seems to be kind of the opposite, where it seems like it's intended for an upward adjustment. And typically that doesn't affect your balance sheet at all, income statement at all, just only the balance sheet. And these two should be maintained in some kind of log outside of your accounting system. So the typical entry goes like debit inventory asset and credit opening balance equity. Last thing, there's a fair amount of time devoted in the chapter for looking at budgeting, and I feel like I don't think you're going to get a lot of return for that in industry, so I'm not going to spend much time on my notes. Looking it up, it appears as though budgeting really is only used by less than 15% of small businesses, and since we're assuming that QuickBooks will be used by small businesses, that's a pretty low return rate. I think the QuickBooks online budgeting function is not likely to be used. So if you do though run across a business that does budgeting, they're much more likely probably going to export the data from QuickBooks and then massage it into a spreadsheet where they do their budget to actual comparisons, because there they can build their budget and play around with the dollar amounts of the budgeted figures, and then the just pull in the QuickBooks Online actuals and use that for a comparison. Okay, well, thanks for listening. Hope this helped.